1999, Silicon Valley. A young engineer just sold his startup for $28 million. His name was David Chen, and he threw a party on a rooftop in Palo Alto. The champagne cost more than most people's monthly rent. Guests whispered about him with reverence. "He's putting it all back into the market," one said. "Smart guy. Internet's the future." By 2001, he was bankrupt. Here's the terrifying part. He didn't make a mistake. He followed every expert. He invested in what CNBC called obvious winners. He diversified across hot IPOs, and like thousands of others, he lost everything. That story isn't rare. It's the American investor's nightmare, repeated across every decade. From 1929 to the dot-com bubble to the housing crisis to meme stocks. People don't change. Markets change. But human psychology remains the same. And that's exactly why this book, written in the 1930s, might be the only thing that can save your portfolio in 2025. This isn't about trends. It's not about hot picks or day trading. It's about building something most investors don't even know they need, a compass. Not for prediction, but for protection. Not for noise, but for clarity. Because the market isn't your friend, it's not your enemy either. It's a mirror of mass psychology. And unless you've trained your eyes to see through that reflection, it will betray you every single time. Today, we're walking through a forgotten roadmap, a philosophy that made Warren Buffett one of the wealthiest men in history, a philosophy born from pain, tested through crashes, and proven across generations. Whether you're trading on Robinhood or managing millions in your 401k, what you'll discover here isn't just wisdom, it's your defense against the next storm. Because the real danger isn't in what you don't know. It's in what you believe to be true that simply isn't. In 2021, people paid $500,000 for digital pictures of cartoon apes. By 2022, those same people were begging someone to take them for $5. The speed wasn't just financial, it was psychological. What collapsed wasn't just money, it was belief itself. Benjamin Graham saw this nearly a century ago. He watched the smartest men on Wall Street follow each other into oblivion in 1929. Not because they lacked intelligence, but because they confused motion with meaning. They mistook speculation for analysis. The market is not your teacher. It's a carnival mirror at dawn. Everyone around you is running, fast and frantic. You hear shouting in the chaos, "This way, no, that way." Some follow rumors. Some chase bubbles. Some mistake the chaos for opportunity. But very few walk with a compass. Picture this. A 24-year-old investor during the pandemic. He opens TikTok. One video says, "Buy Dogecoin." Another screams, "Hold GameStop forever." Reddit tells him he's part of a revolution. He makes $12,000 in a week. He feels invincible. Why wouldn't he? His parents never made money that fast. College never felt this real. In that moment, he's not just rich. He's right, until he's not. 3 months later, his gains vanish. His credit card bills don't. His identity, tied to his portfolio, crumbles with every red candle. He's alone, confused, and most painful of all, he still doesn't know what went wrong. Meanwhile, across the street, another investor made a different choice. No trending stocks, no hype. Just an old-school method. Read the company filings. He bought shares of a boring medical supply company, undervalued but profitable. He held it. It doubled in 18 months. No applause, but no panic either. What Graham wanted us to see is painfully clear. The market will lie to you, but your method must never lie to yourself. The difference between price and value is the difference between illusion and truth. Price screams, value whispers. Price is emotion, value is evidence. In 2025, with TikTok investors, AI-generated portfolios, and headlines that change faster than your mood, the noise has never been louder. But that means one thing. If you can see clearly, you have a massive edge. Ask yourself, have you ever bought a stock just because it was trending? Have you ever felt confident because someone louder, richer, or more popular told you what to do? Now ask this. What if you never needed noise to feel confident again? What if you could build your own compass and walk through the chaos with calm instead of panic? Because this chaos isn't going anywhere. But what we reveal next will change how you navigate it forever. Imagine you walk into a market and someone offers you a Rolex. Limited edition, he says. Only $5,000. You ask, why is it worth that? He grins. Because yesterday, someone paid $6,000. That's not value. That's history. And history in investing is the most seductive liar. Benjamin Graham warned us, value is not what someone just paid. It's what something is truly worth, intrinsically. That's your compass, the invisible guide cutting through emotion, hype, and market euphoria. But let's be clear, intrinsic value isn't a precise number. It's a range, an estimate, a reflection of real cash flow, real assets, and real performance, not dreams. Think of it like this. If you owned 100% of a business, no stock market, no price ticker, just you, the product, the customers, the costs, what would it be worth to you? Not what someone else might pay, but what it actually produces. That's value, and that's where everything begins. In 2019, a retail investor in Michigan noticed something strange about AT&T. The stock was trading at $30, but when he dug into the 10K filing on SEC Edgar, he discovered the company owned Spectrum licenses worth more than their entire market cap. Plus, they were paying a 7% dividend. It was like buying a $100 bill for $75 and getting free cash flow every quarter. He bought, quietly. No YouTube videos, no FOMO. 18 months later, the market caught on. The stock climbed 40%. He didn't get rich overnight, but he didn't need to, because his compass was clear. That's the power of intrinsic value. So, why don't more people use it? Because it's not exciting. It doesn't trend. It doesn't scream. It whispers. And in a world addicted to adrenaline, patience is rebellion. Graham taught that you never pay full price. You demand a margin of safety. You assume your analysis could be wrong because we're all human. So, you protect yourself by only buying when value is unmistakably greater than price. Not possibly, not maybe, unmistakably. So, the next time someone tells you to just buy and hold, ask, hold what? Buy why? Are you buying because the chart looks good? Because your friend said so? Because some influencer made a TikTok? Or are you buying because you see a cash-producing engine, selling at a discount that will keep running whether the market applauds or not? Because once you start asking those questions, everything changes. You stop being a spectator in someone else's game. You become the player with the map. There's a dangerous shift that happens the moment you open a trading app. You stop seeing businesses and start seeing symbols. AAPL, TSLA, NVDA. They're no longer companies with employees, products, and customers. They're adrenaline hits, gambling chips, ego trophies. But Benjamin Graham would tell you, if you're investing in a company without understanding the business, you're not investing. You're speculating with style. The market wants you to forget that every stock represents real people building real things. But your compass demands you zoom back in. It asks, if I could own the whole business, would I? Warren Buffett's biggest breakthrough wasn't some formula. It was this mindset. Don't buy stocks, buy businesses. When he bought See's Candies in the 1970s, it wasn't because the stock was cheap. It was because the company made predictable money, had loyal customers, and could raise prices every year without losing sales. It had what Graham called economic character. But this shift requires different thinking. Imagine you're standing in front of two stores. One is flashy. LED signs everywhere, crowds. It just went viral on social media for its packaging. The other is quiet, clean. It's been on this corner for 20 years. It sells daily essentials. Revenue is slow but stable. Now imagine you could buy the entire store, not trade its stock, but actually own the business. Which would you choose? That's how you should see every investment. In 2020, everyone obsessed over Zoom and tech IPOs. Meanwhile, a retiree in Ohio quietly studied FedEx. Not exciting. No influencers were talking about it. But when he read 5 years of financial reports, he found gold. Revenue was consistent, debt was manageable, margins were growing. And the company had one thing the market ignored: necessity. Even in a crisis, packages still needed to move. He didn't just buy the stock, he mentally bought the business. 12 months later, while tech crashed 40%, his boring investment was up 60%. Because this wasn't about chasing hype. This was about owning something real. Graham's wisdom cuts deeper than numbers. It's about how you see. When you own shares, you're becoming a partner, even if tiny. So ask, would you want this partner in your life? Are they honest, disciplined, profitable, adaptable? If not, why let them handle your money? Here's the brutal truth. Most investors treat stocks like lottery tickets. They're praying, not evaluating, guessing, not analyzing. And when things go wrong, they blame the market. But the market didn't fail them. Their thinking did. Next time you look at a stock, imagine it's a private company. No price ticker, no liquidity. You buy it today and you can't sell for 5 years. Would you still buy it? Because if the answer is no, maybe you never should have bought it in the first place. This is how you stop being a gambler and start being a builder. You stop buying symbols. You start buying meaning. And meaning in the market is rare. But if you can find it, you're already ahead. You can build a fortress, brick by brick, floor by floor. But if you forget the foundation or assume the weather will always be kind, sooner or later the storm comes. And when it does, everything crumbles. That's how most investors behave. They buy great businesses at good prices and think that's enough. But Benjamin Graham warned us, it's not. Because even the best analysis can be wrong. Assumptions fail, markets shift, black swans arrive without knocking. That's why he gave us the investor's ultimate defense, the margin of safety. It's not just a buffer, it's a belief system. It means you never pay full price. You build in room for error. You don't assume you're right. You assume you could be wrong and you plan accordingly. It's humility, weaponized. In 2022, a global beverage company announced declining sales due to health trends. The stock dropped 20%. Analysts screamed, "Buy the dip." But one investor, a former engineer who'd studied Graham's teachings, ran the numbers. The company was still solid, yes. But it had too much debt, shrinking cash flow, and worst of all, its valuation left no room for error. Even a small earnings miss could wipe out future returns. So he waited and waited. 3 months later, after another earnings report missed targets, the market panicked. The stock dropped another 15%. That's when he bought. Not because it was popular, but because the price had finally moved far enough below value to protect him, even if things got worse. That's what margin of safety is. It's not about being greedy. It's about being realistic. Think of it like driving a car. You don't tailgate a truck on the highway. You leave distance. Why? Because you might have to stop fast. The same logic applies to investing. If you buy a stock priced exactly at its intrinsic value, there's no cushion, no reaction time. But if you buy it 30, 40, even 50% below its real worth, you can survive surprises. You don't have to be perfect. You just have to be protected. Warren Buffett's investment in the Washington Post is the perfect example. In the 1970s, he valued the company at over $400 million. The market was offering it for $80 million. That wasn't just a good deal. That was a fortress with 10-foot thick walls. He bought, he held. And it paid off many times over, not because he predicted the future, but because he didn't need to. So here's the challenge. What would happen if, from now on, you refused to buy anything unless the price screamed, "This is safe, even if I'm wrong"? What if your first instinct wasn't, "How much can I gain?" but "How much can I lose before I break?" Because resilience is the real return on investment, and safety isn't boring, it's brilliant. Step into the theater, the curtain rises, the crowd murmurs. On stage, a stock, behind it, a business. But what the audience sees, what they cheer, what they boo, isn't the business, it's the price. The flickering digits, the drama of up and down. And like any great performance, it's not truth they want, it's feeling. Benjamin Graham said it best. In the short run, the market is a voting machine. In the long run, it's a weighing machine. But most people never make it to the weighing part. They're too caught up in the show. Let me tell you about one of the most expensive tickets in modern market history, Nikola Motors. In 2020, the company promised hydrogen-powered trucks, zero emissions, a transportation revolution. It had no revenue, no product on the road, no proven technology. But it had one thing, a story that sold. Retail investors jumped in, hypnotized. At its peak, Nikola was valued higher than Ford. Then came the revelation, the infamous demo video where the truck wasn't driving under power. It was rolling downhill. The curtain fell. Billions evaporated. But this wasn't an outlier. It was a mirror, a reflection of how the market rewards stories more than substance, at least for a while. This is where Graham's compass becomes more than a tool. It becomes armor, because in the market's theater, you will be tempted. There will be applause, bright lights, roaring crowds for companies you know are hollow. You'll hear people say, "Don't miss out," and "This is the future," and your fear of missing the next Tesla will scream louder than your logic. That's when you breathe, step back, ask Am I watching the show, or am I investing in the script? Speculation is seductive because it rewards ego. You buy today, it goes up tomorrow, and suddenly you feel like a prophet. But investing, real investing rewards discipline, delayed gratification, the kind of inner strength that feels invisible until it saves you. Remember, when you buy a stock, you're not buying the spotlight. You're buying the business behind the curtain. And if that business is weak, no matter how dazzling the act, the fall is inevitable. So, what do? You watch the show, but you don't get on stage. You analyze, but don't fantasize. You treat price as a signal, not a story. When everyone is clapping, you check the foundation. When they're booing, you look for hidden strength. And when they panic, that's when opportunity emerges. Because the theater always ends the same way. The lights come on, the illusions vanish, and only the weight remains. A company reports a record-breaking quarter. Profits are up 80%. Headlines explode. Analysts raise targets. Social media lights up with buy, buy, buy. And yet, 3 months later, the stock plummets. Investors are blindsided. But they were profitable, they whisper, dazed. No, they weren't. Because profit isn't always profit. And numbers can lie, especially when they're designed to. Benjamin Graham was obsessed with this exact danger. He didn't just teach us how to read financial statements. He taught us how to question them. Because between gross margins and net income, between EBITDA and earnings per share, lies a battlefield. And unless you know where to look, you'll become collateral damage. Here's the truth. Companies don't report earnings to inform you. They report to impress you. Say a company sells $100 million worth of product, but it also spent $110 million to manufacture, market, and deliver it. On paper, it's losing money. But now, imagine they delay certain expenses, use creative accounting to reclassify costs, recognize revenue early. Suddenly, they post a net income of $5 million. But look deeper. Their cash flow is negative. That's not profit. That's lipstick on a spreadsheet. WeWork is the perfect example. In 2019, they introduced a new metric, community-adjusted EBITDA, a made-up term designed to show profitability that didn't exist. It excluded basic expenses like rent, the thing they literally do for a living. Investors bought into the story, not the math. And when the math caught up, the empire imploded. Graham would have seen it coming, because he didn't trust earnings alone. He trusted cash. Cash flow is the blood of a business. It doesn't lie. It doesn't get adjusted. It doesn't need interpretation. It either shows up or it doesn't. So, how do you protect yourself? Start here. Compare net income with cash from operations. If a company is showing profit but bleeding cash, that's a red flag. Next, check the footnotes. Most financial landmines aren't in bold. They're buried in fine print. Then, look at working capital trends. Are they delaying payments, rushing receivables, manipulating timing? Finally, ask the question no one asks in bull markets. Is this real? Because illusions don't just hurt you when they fail. They hurt you while they're rising by luring you away from better opportunities. The point isn't paranoia, it's precision. It's understanding that real businesses make real money, and you, as an investor, should settle for nothing less. So next time a company boasts, "We had a record quarter," remember? The most dangerous lies are the ones dressed in numbers. Markets surge, markets crash, people cheer, people panic. But the true investor, the one Graham envisioned, is not tossed by every wave. He doesn't build his wealth on a surfboard. He builds a seawall. He prepares, not predicts. He endures, not reacts. Because if the market is the sea, then emotion is the tide. It pulls investors in and out of logic. 1 minute, everyone's a genius. The next, they're selling at a loss and promising to never invest again. This cycle isn't new. It's ancient. But it's never been more accelerated than today. In 2023, a fintech startup went public at a $5 billion valuation. They made no profit, had no competitive advantage, and their user base was shrinking. But the promise of disruption, of Web3 meets banking, was enough to send the stock soaring. FOMO kicked in. Even seasoned investors gave in. The stock doubled in 2 weeks, then dropped 80% in 4 months. What changed? Nothing. Except the mood. That's why Graham's wisdom was never just about numbers. It was about temperament. He believed investing success required emotional discipline more than intellectual brilliance. In fact, he said the investor's worst enemy is likely to be himself. Your greatest threat isn't the market, it's your reaction to it. You see a sea of red, your stomach turns. You hit sell, not because it's smart, but because it feels safe. You see a wave of green, your heart races. You hit buy, not because it's right, but because you're afraid to miss out. This is how wealth evaporates, not in one bad trade, but in 1,000 small emotional decisions. Now imagine a different investor. He builds his portfolio the way an engineer builds a dam. He knows storms will come. He doesn't try to outrun them. He expects them. He builds his investments with margin of safety, with undervalued businesses, with cash flow and patience. So, when the wave crashes, he doesn't drown. He watches, waits. And when the flood recedes, he steps forward, ready to buy what others fear. This isn't fantasy. This is what Buffett did in 2008. When Lehman collapsed, when CNBC screamed "End of capitalism," he wrote op-eds saying he was buying American businesses with both hands. Why? Because his seawall was already built. He didn't need to feel safe. He already was. So, how do you build that same resilience? Start by setting rules, not feelings. Define your investment criteria before you invest a single dollar. Decide when to sell before the panic hits. Keep cash for the chaos, not because you're scared, but because you're smart. Then study your own behavior. Track what you do, not just what you think. Look at your trades. Were they based on headlines or homework? Because when the sea rises, and it always does, you won't rise with it unless your foundations are buried deep. You don't have to predict the tide. You just have to be unshakable when it changes. There's a certain thrill in finding something that looks cheap. A $10 stock that once traded at 50. A company whose price-to-earnings ratio is half the market average. Your instincts whisper, this is a steal. But not all discounts are deals. Sometimes cheap is just the final price before collapse. Welcome to the value trap. Benjamin Graham warned us. Low price does not equal low risk. In fact, the illusion of safety can be more dangerous than obvious speculation. Because when we think we're being smart, buying undervalued assets, we let our guard down. And that's when the trap snaps shut. Let me take you back to a case few saw coming. General Electric. For decades, GE was a titan. A household name, diversified, respected. But by 2017, its stock had dropped from over $30 to under $10. Value investors swarmed. The metrics looked compelling: low price to earnings, high dividend, global brand recognition. But the deeper story was rotting. GE's balance sheet was bloated with opaque liabilities. Cash flow was deteriorating. The dividend was unsustainable. But the price created an illusion of value. It can't go lower, they said. But it did. And those who bought the illusion paid the price. The lesson? Don't just ask if something is cheap. Ask why. Graham taught us to investigate, not just calculate. A company might look undervalued on the surface, but beneath? It could be bleeding customers, facing existential threats, holding outdated inventory, or hiding debt behind aggressive accounting. A value trap is like a beautifully wrapped gift box with nothing inside. It's not just disappointing, it's devastating. But how do you spot one? Start with this. Compare declining price with declining fundamentals. If both are falling, be cautious. Look for catalysts, real ones. A turnaround plan, management changes, structural improvements. If all you see is hope, you're not investing. You're gambling in a cheap suit. And here's where your emotional compass is just as important as your analytical one. Because value traps feed on pride. You buy in, thinking you're smarter than the market. The stock drops. You double down. Now it's really undervalued, you tell yourself. You ignore the signs. You defend the mistake. And soon, you're not analyzing anymore. You're protecting your ego. Every investor, yes, even the best, falls into this at some point. But the difference is how quickly they recognize the trap and climb out. Not every falling stock is a value trap. Sometimes the market overreacts. That's where opportunity lives. But without deep, cold analysis, you won't know which is which. So next time you see a cheap stock, ask yourself, would I still buy this if the price were higher? If the answer is no, then maybe the only thing that makes it attractive is the discount, not the value. And in investing, discounts without depth are just bait. Picture a crowded building suddenly filling with smoke. One person starts to run, then another. Within seconds, everyone's sprinting. No one knows why. They're not running towards safety. They're running because others are. That's how most people invest, and that's why most people lose. Benjamin Graham's timeless insight wasn't just about what to buy. It was about when not to move. In markets, motion is seductive, but stillness, strategic, conscious stillness, is what builds fortunes. During the 2021 crypto boom, coins named after dogs and memes hit billion-dollar valuations. You could almost hear the stampede. Even smart people joined in, not because they believed, but because they were afraid not to. That's what FOMO really is. Fear of isolation dressed up as opportunity. And Graham would have said this: when the crowd runs, don't follow, don't even walk, stop, observe. Ask the question no one asks during a stampede: where is everyone going, and why? But this discipline isn't just theoretical, it's tactical. Let me tell you about a retired teacher in Phoenix in 2022. Everyone around her was piling into AI and fintech stocks after viral YouTube videos. Her friends showed off gains. Some made 20% in a week. The pressure was real. But instead of chasing, she did something radical. She turned everything off. No news, no apps, no social media. For 1 week, she went back to financial statements, looked at earnings trends, competitive advantages, management behavior, and she waited. While the crowd ran, she sharpened her lens. 3 months later, the hype stocks had crashed, but she bought into a utility company at half its asset value, not because it was trendy, because it made sense, because she had clarity while others had speed. That's what Graham taught. You don't make money by running faster. You make money by thinking longer, because the market is built to manipulate your urgency. Act now, buy the dip. Don't miss this. Every headline, every algorithm, every influencer, even the good ones, are designed to accelerate your decision-making. But your greatest edge is slowing down, because when others move with fear, your stillness becomes power. This isn't easy. It means sitting on cash while others flex their portfolios. It means being late to trends that vanish before they pay off. It means saying no 99 times before saying yes once, and then saying it with conviction. But that's how wealth works. It's not loud. It's patient. And it's usually invisible until it's undeniable. Ask yourself, when was the last time you paused in the middle of a frenzy? When did you not act, even when everything around you screamed to do something? Because that is investing maturity. Graham didn't just give us formulas. He gave us posture, the discipline to be unmoved while others panic, the clarity to see fog for what it is, temporary. Every day you are offered opportunities, newsletters, stock tips, new IPOs, viral YouTube predictions, whispers from friends who say, this one is about to explode. The market doesn't lack noise, it lacks filters. And that's where most investors fail, not in choosing wrong, but in choosing too much. Benjamin Graham didn't invest in every good deal. He invested in the right deal. And his greatest discipline wasn't spotting winners. It was saying no to everything that didn't meet his standard. He understood this truth. Every yes you give steals time, focus, and capital from something better. Warren Buffett, his most famous student, once said, "The difference between successful people and really successful people is that really successful people say no to almost everything." That's not ego. That's engineering. So, how do you apply this? You build a checklist, a gatekeeper, a system that filters out 99 out of 100 ideas, not because they're terrible, but because they're not excellent. Let's say a company lands on your radar, hot sector, trending narrative. The numbers are okay, but there's high debt, thin margins, weak cash flow. It might work, but it also might not. If you're tempted, stop and ask, if I could only buy 5 stocks this year, would this be one of them? If the answer isn't a hard yes, it's a no. This principle saved one investor I know in early 2023. He was offered a stake in a promising electric vehicle startup. Great pitch. The founder was charismatic. The growth chart, exponential. But the investor had rules. He checked customer retention, weak, burn rate, too high, path to profit, unclear. It didn't pass the filter. He walked. 6 months later, the company imploded under cash flow pressure. He didn't feel smart. He felt safe, because discipline isn't about genius. It's about design. The market will always offer shiny distractions, but each distraction is a test. Do you act because it's compelling or because it meets your compass? Here's the metaphor. You're not a tourist taking pictures of everything that looks interesting. You're an archaeologist, digging with purpose. If the soil doesn't match the map, you move on. No guilt, no regret, just mission. And this has emotional power too. Saying no frees you. It gives you peace during bull markets. It gives you patience during corrections. And most importantly, it protects your capital for the moments that actually matter. Remember, your time, your attention, your money, they are limited. Every careless yes you say is a thief in disguise. But this isn't about scarcity. It's about focus. Because when you do find the right opportunity, one that screams value, safety, clarity, you'll have the resources to act boldly, not timidly, not halfway, but with conviction. And that's where wealth is built, not by volume, but by velocity at the right moment. Most people treat investing like fishing. They cast their line into the market hoping something bites. Maybe they get lucky, maybe they don't. But the problem isn't the bait, it's the method. Because real investing isn't casting into unknown waters. It's solving a puzzle where every piece has to fit before you act. Benjamin Graham didn't make bets. He made cases. Every company he considered had to survive a brutal cross-examination. He didn't just look at earnings. He asked, can this business endure? Is its price lying? Does the story match the substance? Think of it like this. You find a company. At first glance, the price looks low. That's the picture on the box. But then you open it, and now the pieces are everywhere. Balance sheets, income statements, management bios, industry risks, macro trends. Most people peek at a few, feel overwhelmed, and close the box. But Graham, he laid every piece out, one by one, slowly, systematically. And this is your edge in 2025. While AI traders make decisions in milliseconds, while retail investors chase trends, you build puzzles. In 2003, Buffett, trained in Graham's methods, bought a massive stake in PetroChina. No Wall Street buzz, no media campaign, just a quiet investment. Why? Because he read the annual report. That's it. In that report, he saw something incredible. The market was valuing the entire company at $35 billion. But based on its assets, profits, and cash flows, Buffett estimated it was worth at least $100 billion. That wasn't a gamble. That was a puzzle solved. He bought, held, and within a few years, the market caught up. The position earned him over $3 billion, not from prediction, from precision. But what does this look like for you? You don't need to be a billionaire to act like one. You just need process. Start here. Read the last 3 years of 10K filings on SEC.gov. Do revenues grow consistently? Are profits stable or inflated? What does debt look like? Short-term versus long-term. Then, check insider behavior on Form 4 filings. Are executives buying shares with their own money or selling at every spike? Next, study the competitive advantage. What makes this business hard to replicate? Is it brand, scale, regulation, network effects? Finally, test your thesis. If the price rose 50% tomorrow, would you still want to buy it? If the market shut down for 2 years, would you be happy to own it? This level of thinking filters noise. It replaces hope with clarity. And here's the secret. It's not about being right 100% of the time. It's about being prepared 100% of the time. Because when you build a habit of deep analysis, you stop reacting and start anticipating. You stop chasing and start choosing. And over time, that discipline becomes identity. You're no longer a market participant. You're a market interpreter. You see what others miss. You connect dots they can't even see. Imagine building a house. You hire an architect. You pick the design. You choose the color of the walls, the height of the ceilings, the shape of the windows. Everything looks perfect, but you skip one thing, the foundation. You assume it's solid. You never check. Why would you? The house looks beautiful. And then one day, without warning, it collapses. That's how most people invest. They fall in love with the vision. They obsess over momentum. They decorate their portfolio with hopes and trends. But beneath it all, they never check the structure. Benjamin Graham knew better. He understood that the foundation of any company, the thing that holds it up when storms come, is its financial health, not revenue hype, not marketing buzz, not stock chart shapes, but hard, often boring numbers, assets, liabilities, equity, working capital, debt structure. Because when markets fall, and they always do, it's not hope that holds a company together, it's solidity. In 2020, during the COVID crash, Thousands of companies saw their revenues plummet, but some survived without blinking. Why? Because they had strong balance sheets, low debt, high liquidity, reserves. They didn't need to borrow just to stay alive. They could withstand the storm. Compare that to companies that relied on cheap credit and inflated projections. When the tide went out, their foundation was exposed and it was rotten. Many didn't recover. So, how do you check a foundation? Start with the balance sheet. Look at total debt versus total assets. Then ask, can this company pay its short-term obligations with its short-term assets? That's your current ratio. Is it above 1.5? Good. Below 1.0? Red flag. Next, examine equity. Is it growing, or is the company relying on debt to fake growth? Then, cash flow. Not net income, cash. Is the business generating real operational cash after expenses? If a company fails here, it doesn't matter how good the product is. It's fragile. It can't survive a shock. And investing in fragility is not strategy. It's suicide. But here's where this gets personal. Ask yourself, have you ever bought a stock just because the chart looked good? Just because someone said, it's going to explode, without ever checking if the business could weather a crisis? Most of us have. Not because we're dumb, but because we're emotional. We want upside. We ignore downside. We chase the roofline without checking the cement. Graham gave us a better way. He taught us that value isn't just about upside. It's about staying power. It's about companies that can bend without breaking, adapt without begging, survive without miracles. This approach isn't flashy. It won't get you trending on Twitter, but it will let you sleep at night. And in a world obsessed with speed, sleeping well is a superpower. So next time you consider an investment, ask this. If a financial earthquake hit tomorrow, would this company stand? Because if the answer is no, then no price is cheap enough. We've walked through the fog together, from the Silicon Valley entrepreneur who lost everything to the principles that could have saved him, from market psychology to balance sheet analysis, from speculation to true investing. But now, let's return to where we started, that 28-year-old engineer, David Chen, who lost $28 million following the crowd in 1999. Here's what could have saved him. Not a prediction, not insider information, not luck. Just one simple question, the question Benjamin Graham would have asked. Am I buying this because everyone else is, or because the business is actually worth more than I'm paying? That's it. That's the compass. Not the complexity of modern finance. Not the noise of cable news. Not the algorithms or the hype. Just the discipline to ask, what is this really worth? And am I paying less than that? David bought Pets.com at $60 per share because everyone said e-commerce was the future. But if he'd asked Graham's question, he would have seen the truth. A company burning cash with no path to profitability, trading at 20 times revenue with no earnings in sight. The future was right. E-commerce did change everything, but the company was wrong. And in investing, timing means nothing if you're in the wrong boat. Today, in 2025, with AI hype, crypto comebacks, and meme stocks still making headlines, the fog is thicker than ever. But that means your compass is more valuable than ever. Because while everyone else is guessing, you'll be analyzing. While they're reacting, you'll be prepared. While they're hoping, you'll be building. So here's your next step. Not tomorrow, not next week. Today. Pick one stock you own or one you're considering. Go to sec.gov. Pull up their latest 10K filing. Read it. Not the summary, not the highlights, the actual document. Ask yourself, if I owned this entire business, would I be happy? If you can't answer that question with confidence, you're not investing. You're speculating. And if you discover you've been speculating, don't panic. Every great investor started there. Buffett did, Lynch did, even Graham did. The difference isn't in being perfect from the start. It's in building the discipline to improve. This isn't the end. It's the beginning. The beginning of investing with purpose instead of hope. With analysis instead of emotion. With a compass instead of a crowd. Because the truth was never hidden. It was just waiting for you to look. And now you know where to look.